Hi there. Most freelancers overpay UK tax simply because they miss the allowable expenses HMRC actually approves. In this video, I'll show you how to optimize your 2026 self-assessment deductions properly.
Let's be honest, navigating UK taxes when you're a freelancer can feel like you're walking through a minefield. Are you claiming everything you're actually entitled to? And maybe more importantly, are you worried you might be claiming something you shouldn't? Well, you're in the right place. We've teamed up with the expert tax advisors at My Tax Accountant to give you a clear, no-nonsense guide to optimizing your deductions. Let's make sure you keep more of your hard-earned money and, crucially, stay on the right side of HMRC in 2026 and beyond. Right, I want to start with a number that should really make you sit up and listen. 60%. That's how much of the UK's entire £46.8 billion tax gap HMRC says comes from small businesses. We're talking about a jaw-dropping £28 billion in uncollected tax. And because of that, HMRC is now absolutely laser-focused on freelancers and sole traders, which means it's never been more important to get your expenses spot on. So, why the sudden urgency? Well, HMRC has seriously upgraded its toolkit. It's now using incredibly sophisticated digital tools and AI that are designed to scrutinize your expense claims with a level of detail we've just never seen before. The old days of, guesstimates and rounding up your figures, they are officially over. And you'll definitely want to hear this part. With Making Tax Digital rolling out fully from April 2026, forcing digital records and quarterly updates, the margin for error has become paper-thin. Okay, so first, let's unpack what this new digital focus from HMRC actually means for you day-to-day. This isn't just about them getting some new software. This is a fundamental change in the relationship between you, your business, and the taxman. We're moving towards real-time data and total transparency. This chart right here, it tells you everything you need to know about HMRC's priorities. That huge 60% slice of the pie coming from small businesses isn't just a number. It's a giant, flashing neon sign. It shows you exactly why your tax return is suddenly under the microscope. Look, it's nothing personal. It's just that statistically, small businesses are now right at the very top of their compliance checklist. And listen, this isn't just me speculating. This is a direct warning from HMRC itself. A recent trial of these new digital checks managed to pull in an extra £27 million from incorrect expense claims alone. That trial was so successful that it's now being rolled out across the country. The takeaway here is really simple. They have the tools, they've proven they work, and now they're scaling up the entire operation. Okay, so with the risks being so clear, how do you build a bulletproof expense strategy? Well, it all comes down to mastering one core principle, the absolute bedrock of every single expense claim, the wholly and exclusively rule. Understanding this is your first and by far your best line of defense against any questions from HMRC. To put it simply, for a cost to be an allowable expense, you must have spent that money 100% for your business. So, for example, a new laptop that a graphic designer in Manchester buys purely for her client work, that's clearly allowable. But the family's Sky TV and streaming subscription, that's a personal cost, even if she occasionally watches a business documentary. For any expense that has a mixed use, you can only claim the business part of it, and you have to have a logical way of working that out. Now, it's also really important to know the difference between two types of costs. First, you've got revenue expenses. Think of these as your daily running costs, things like software subscriptions, stationery, or your phone bill. You deduct these from your profit straight away to lower your tax bill for the year. Then you have capital expenses. These are for bigger assets your business will use for a while, like a new camera, a laptop, or even a van. Usually, you'd claim these back slowly over several years through something called capital allowances. But, and this is a key tax break you need to know about, the annual investment allowance currently lets most freelancers deduct the full cost of these assets in the same year you buy them. It's a huge benefit, giving you that tax relief right away. All right, with those principles clear in our minds, let's get practical. We're now going to walk through a checklist of the most common, and let's be honest, the most confusing expenses you'll face as a freelancer. This way, you'll know exactly what you can and can't claim. First up, the big one, working from home. HMRC offers a simplified, flat-rate method. If you work over 25 hours a month from home, you can claim a set amount, up to £26 per month. It's incredibly easy, no complicated sums needed. But, and stay with me because this is a really big but, it might not actually be the best option for you. This flat rate only covers the extra heat and light you're using. You can still claim your business phone and internet costs on top of it. The alternative, and this is the one that often leads to a much bigger deduction, is the actual cost method. Here, you calculate a fair and reasonable proportion of your actual household bills, and that includes things like your mortgage interest, council tax, and utilities. So for instance, if a consultant in Birmingham uses one of 5 rooms in their home exclusively as an office, they could claim 20% of those total costs. That could easily mean an extra £500 or more in tax relief each year compared to the flat rate. The key here, and this is absolutely non-negotiable, is you have to keep meticulous records to justify how you got to that number. Now let's talk travel. When you use your personal car for business trips, you can claim a simplified mileage allowance. This is great because it saves you the headache of tracking every single penny you spend on fuel, insurance, tax, and repairs. The approved HMRC rate is a nice, straightforward 45 pence per mile for the first 10,000 business miles you do in a tax year. After that, it drops to 25 pence per mile. But here's the catch, and honestly, this is what catches so many people out. To claim that 45 pence per mile, you must keep a detailed mileage log. And I mean detailed. The date, the start and end points of the journey, the specific business purpose, like meeting with client X, and the exact number of miles. HMRC is incredibly strict about this. No log means no claim. It really is that simple. Just as important as knowing what to claim is knowing what you can't claim. A lot of freelancers get tripped up here. Taking a client for lunch? I'm afraid that's called client entertaining, and it's not an allowable expense. Buying a smart suit for a big meeting? Well, HMRC sees that as ordinary clothing because it has a dual purpose. You could wear it somewhere else, so it's not deductible. Also on the banned list are any fines or penalties, most business gifts over £50, and crucially, you can't claim your own salary or the money you draw from the business as a tax-deductible expense. So, you get the rules. Now, let's talk about how to submit your tax return in a way that doesn't trigger an HMRC inquiry in the first place. It's all about understanding and avoiding those common red flags their systems are literally programmed to hunt for. HMRC's automated system, known as Connect, is designed specifically to spot things that look odd. It flags things like perfectly round numbers. Claiming exactly £1,000 for office supplies looks like a guess, not an actual record. It also questions unusually high expenses compared to your business turnover, and it will definitely flag big, unexplained jumps in your claims from one year to the next. And here's a tip for you. HMRC is now specifically targeting mixed-use claims for cars or home offices that are over £2,500. Precision is your best defense, always. So what's the action plan? Well, it's a simple 4-step process. First, keep digital records. Get an app or some software. This sets you up perfectly for making tax digital and just makes your life easier. Second, get a separate business bank account. This creates a really clear firewall between your business and personal spending. It makes your records clean and simple. Third, justify every single claim. Get into the habit of attaching a quick note to your digital receipts explaining the business purpose. And finally, number 4, file on time. It's basic, but it sends a powerful signal to HMRC that you're organized and on top of your affairs. We've covered a lot of ground today, haven't we? From HMRC's big digital shift all the way down to the nitty-gritty of what is and isn't an allowable expense. So let's just bring this all together now with one final crucial thought that can take you from just being compliant to being truly confident. This really leads us to the fundamental question. After everything we've talked about, are you genuinely confident that you're claiming every single pound you are legally entitled to, while also being 100% certain that your records are strong enough to stand up to a detailed HMRC inquiry? It really is all about that peace of mind. And before we finish, it's very important that we state the official disclaimer. The information we've provided here today is for general guidance only. You really shouldn't rely on it as a substitute for professional tax advice that's tailored specifically to your unique circumstances. If that last question gave you even a moment of doubt, then honestly, the best next step is to get some professional guidance. The team at My Tax Accountant can offer you personalized advice to make sure you're both tax efficient and fully compliant. Their contact details are right there on the screen now. And don't forget to subscribe to their channel for more essential updates for UK freelancers. Take control of your taxes. Thanks so much for watching.